Let's connect with the top management of Care Rating. Mr. D.R. Dogra, Managing Director of Care Rating, joins us. Mr. Dogra, good morning and thank you for joining us. Characterize the business environment for us, because surely the sentiment has changed, but is better sentiment translating into better business?
Yeah, good morning Nikunj, and good morning to all viewers of ET Now. You are right. I think this year is quite crucial for us because with change of government, the sentiment on the economy has really gone up, and fortunately we have Q1 GDP numbers which is really good. Though we cannot simply jump to the conclusions as of now, because there are some related number like credit growth, which number is not that good as compared to even last year. And whatever growth has come is not come on the corporate side, so mostly on the personal retail segment side. But certainly the government has been taking several steps, and I think sentiment has improved. It's only a matter of time before the interest rate cycle starts coming down and investment cycle starts, and that's the time when all of us in the rating industry should start doing much better than what we have been doing in the past 2 years.
Morning. Talking about Care Ratings in specific, what's your own outlook on your overall revenue growth and profit growth as well? And what, according to you, are going to be the key revenue drivers going forward?
Yeah, Aisha, good morning. Aisha, as you know, we don't give any guidelines on our revenues and all that, but looking at the credit growth in the past decade or so, I think expecting a growth of 15 to 20%, though we have done much better in the past. But I think expecting a growth around 15 to 20% for the industry as a whole in a medium term, 3 to 5 years period should not be a unreasonable expectation. And I think we have always been doing much better than the industry. I think we should be doing little better than that.
But margins, do you think your margins are sustainable given that you are likely to grow more in the SME segment this time around, where yields are typically much lower?
Aisha, you are right. In fact, you are seeing even that for last 2-3 years we have seen some erosion in profitability margins because our proportion of SMEs is going up. Though we are a very, very small player as far as SMEs are concerned, we are a very, very focused player on the large corporate, and I think as long as we start going more and more into SME space, which we are intending to do, you are right that for some time projects profitability margins may take a slight hit, but I think after we are able to generate economies of scale even on SME front and keep our cost under control, which we have been able to do more or less much better than the industry in large corporates. So why we should not do this even in small corporates? If we are able to do that, I think we can sustain these margins once again after some time.
Sometime, Mr. Dogra, is it just a few quarters, 2 or 3 quarters, or could it stretch down to
sometimes I would mean around 2 years. Yeah, around 2 years, yes.
Mr. Dogra, the IPO market seems to be opening up once again, and as per the SEBI guidelines now, IPOs, before they hit the primary market, they have to go to a rating agency. Is that a big business opportunity for you? Is that a vertical which was a dead vertical? Is that vertical looking at making a comeback?
Yeah, there are 2 reasons, Nikunj. This was almost a dead vertical. Number one, the IPOs were not there. Secondly, IPO grading is not compulsory now. It's optional. So these are the 2 reasons which have keeping us away from the IPO grading market. But as you know now, the market is quite conducive for the IPO environment. I think this business might start once again, because the good issuers will certainly even go for rating even if it's not compulsory.
Mr. Dogra, exactly about 6-7 quarters ago, some of the key stakeholders, they were keen to offload their ownership in Care. There was a buzz, investors, they came in, they gave a bid, that bid was not accepted to your shareholders. Any update on that? Are some of your big shareholders still keen on exiting Care?
See, Nikunj, as you know, this is a matter between the shareholders and the prospective buyers, so we would not be in the picture most of the time unless, we keep on talking to investors. So maybe some of the investors which we talk to could be the possible buyers from our institutional shareholders. But our shareholder has been very, very firm and strong with this company for last over 20 years. IDBI, Canara Bank, took stake in this company in 1993, so they have seen many ups and downs, and I think if somebody, there has to be some time when you have to get out of investments also, so I don't think it's and they are still the first and second largest shareholders of CARE. So even if they shell out, some part of it, I don't think your family gold is meant for, whenever you have liquidity requirement, you can really give away part of this. So, but I don't know what are the plans now, but yes, you are right, there were some plans earlier. And I think they thought that it's not the right time for them to sell, and I think time has proved that, we are much better on the capital markets now as compared to that time.
Both CRISIL and ICRA are your competitors. They have strong foreign partners, Mr. Dogra. Are you also looking at one or a PE player?
Aisha, I don't think there are any worthwhile partners in the international scene. S&P and Moody's are too large, and the third largest rating agency is a distant third. And we know that CRISIL has been considered as a number 4 rating agency, number 4, and we are neck to neck with CRISIL now, except some SME work which we don't do, and large annuity which they have because they came 6 years before CARE came. There's not a large difference between CRISIL and CARE now. So if they are number 4, we should be number 5. So I don't think if first, second and third are already in India and fourth is the subsidiary of a first one, so I don't think there could be a bigger partner available for us now.
Is that a limiting factor?
Whoever joins us,
Mr. Dogra, is that a limiting factor, the fact that you don't have a global large player? Is that a big handicap for you when you bid for big mandates, because your competition would say, look, we've got global experience, we've got size, we've got reach, and we've got years and years of experience?
I don't think so, and the spectacle situation on the ground speaks contrary, because international rating agencies don't do domestic rating. It's only the domestic subsidiary of an international rating agency which does domestic crediting in India. It's not S&P, Moody's or Fitch do the domestic ratings in India. It's their domestic subsidiaries which are doing this work, and more so with me. So I don't think shareholding does matter in doing a domestic rating. Yes, international rating, even other rating agencies who have an international partner don't do international rating, like I don't do international ratings. And you may be knowing that we are a part of we own a company which is an international rating agency now known as ARC Ratings, where CARE owns 20% stake in that company. And if we believe in the emerging market story, everybody believes that tomorrow emerging markets would be one of the bigger raisers of international finance and will require international ratings. So companies from India, CARE, from Malaysia, MARC, from Brazil, SR Ratings, from South Africa, GCR, Global Credit Rating Agency, and a one Portuguese rating agency joined together and formed a company known as ARC Ratings, which is a recognized rating agency by European Security Markets Authority. That means we are a recognized rating agency in 30 Eurozone countries, and that rating agency has already come in from 16th of January 2014, and we have launched operations there. So we own a rating agency now. We are not owned by any international rating agency, but we own a international